Are you building the next big thing, but stuck choosing between venture capital and bootstrapping? Your funding decision could make or break your startup. Let's break it down, fast. Listen up. Every founder, every hustler with a dream burning in their gut eventually stands at a crossroads. This isn't some minor detour. This is the fork in the road that defines your entire journey. On one side, you have the glittering allure of venture capital, a rocket ship fueled by other people's money, promising to blast you into the stratosphere. On the other, the gritty uphill climb of bootstrapping, building your empire with nothing but your own sweat tears, and whatever you can scrape together from your own pockets. This decision isn't just about money, it's about control, speed, pressure, and legacy. It's the first real test of your vision, and making the wrong choice can crash your dream before it ever gets off the ground. Don't get it twisted, there's no easy answer here. The path that turns one founder into a legend could be the very thing that buries another. This is where you have to be brutally honest with yourself. Are you building a business to change the world overnight? Or are you crafting a legacy that you own, piece by piece? Are you willing to hand over a slice of your company for a shot at exponential growth? Or is total control non-negotiable? This choice will dictate the culture of your company, the speed at which you operate, and the kind of pressure you'll wake up with every single morning for the next decade. Think of it like this. You're standing at the starting line of the most important race of your life. The VC path hands you the keys to a Formula One race car. It's phenomenally fast, ridiculously powerful. Let's talk about venture capital. VC funding is high-octane fuel for your startup's engine. Professional investors, venture capitalists, manage massive pools of money from institutions and wealthy individuals. They aren't just cutting you a check, they're buying a piece of your company. They believe your idea could deliver an explosive return 10 times, 100 times. They're betting on you to build the next unicorn and giving you cash to move at lightning speed. This is the path for founders with a massive, scalable idea, needing huge upfront investment to capture a market. The upside is massive. With a major cash injection, you can hire the best talent, launch aggressive marketing campaigns, scale operations, globally crush your competition. You're not just getting money, you're getting a powerful network. VCs open doors. They connect you with industry giants, potential partners, future customers. Board members bring decades of experience offering strategic guidance through hyper-growth. For founders in biotech, deep tech hardware where R&D costs are astronomical, VC funding is often the only way. But don't be naive. This rocket ship has serious strings attached. The moment you take the VC check, you're strapped in and the countdown has begun. Investors expect massive returns and they expect them fast. The pressure is immense. You'll answer to a board of directors, face aggressive quarterly growth targets, and risk being replaced if you don't perform. You're no longer the sole captain. You've sold a piece of your dream, giving up control and ownership. Each funding round dilutes your stake. You own less and less of the company you started. VC can pave the way to a billion-dollar valuation, but it's a high-stakes gamble. You're trading autonomy for acceleration, a piece of your soul for a shot at the stars. Founders who thrive here are comfortable with intense pressure, can execute flawlessly under scrutiny, and see their investors as true partners. If you want to grow as big as possible, as fast as possible, and you're willing to share the driver's seat to get there, then the VC rocket ship might be your ticket to the stratosphere. VC, massive capital, rapid scale, diluted control. Now let's get down to the grind. Now let's get down to the grind. Bootstrapping is the art of building a business from the ground up with nothing but personal savings and the revenue your company generates. There are no investors, no board of directors, no one to answer to but yourself and your customers. This is the path of the ultimate hustler, the founder who is willing to eat ramen for years, who will work out of their garage, who will pour every single dollar of profit back into the business. It's slow, methodical, and often painful. You are the CEO, the janitor, the salesperson, and the customer service rep, all rolled into one, a testament to pure grit and resourcefulness. The biggest advantage is crystal clear. You maintain 100% control and 100% ownership. Every decision, from logo color to long-term strategy, is yours and yours alone. No investors breathing down your neck, no unrealistic growth targets, no premature exit pressure. You grow at your own pace, a sustainable pace set by revenue. This forces you to be lean, creative, and incredibly disciplined. You learn the value of every single dollar because it's your dollar. That lean mindset builds a stronger, more resilient culture focused on profitability and customer satisfaction from day one. Of course, the path has challenges. Growth is almost always slower. While a VC-backed rival launches multi-million-dollar ads, you're handing out flyers, you're on a financial tightrope. One bad month, one unexpected expense, and the operation is at risk. The personal toll is immense. Burnout risk is very high when you carry the company's weight, working 80-hour weeks with little to no pay, watching friends buy houses and take vacations. It's lonely and stressful. Bootstrapping isn't for the faint of heart. It's for founders who value independence above all, who have models that can generate early cash flow, and who have the patience and mental fortitude to play the long game. It's about building a sustainable, profitable business you own outright, brick by painstaking brick. If you want to build a legacy on your terms, who finds pride in the struggle? Who'd rather be king of a small, self-built castle than a prince in someone else's kingdom? Then the bootstrapper's grind is your calling. Bootstrapping, total control, slower scale, personal risk, bridge to side by side. Let's break it down head to head. First up, speed. In the startup world, speed is often everything. The VC path is built for pure, unadulterated velocity. When you close a Series A round, you're not just getting money, you're getting a mandate to floor it. You hire aggressively, spend big on marketing, acquire customers at a pace that would be impossible otherwise. This is blitz scaling, growing at a breakneck pace to achieve market dominance. It's a land grab. Become the default choice in your category so quickly that the competition is left choking on your dust. This speed is a powerful weapon, but it's also a double-edged sword, burning through cash and making costly mistakes. On the flip side, bootstrapping is a slow burn. Growth is organic. Growth is deliberate. Growth is tied directly to your profits. You can't afford to hire a team of 50 overnight, or launch a Super Bowl ad. Instead, you grow incrementally. One customer, one hire, one small marketing experiment at a time. This deliberate pace forces you to be strategic and efficient. It lets you build a deep understanding of your customers and refine your product based on real feedback. You might miss being first to market, but you often get a more stable foundation and a clearer path to long-term profitability. Scalability follows this speed differential. VC funding is for businesses with massive scalability potential. Investors want ideas that can grow to $1 billion valuation. They provide capital to build infrastructure for explosive growth, build systems for 10 million users, even when you only have 10,000. This preemptive scaling is essential in winner-take-all markets. Network effects make being the biggest the only thing that matters. You build for the future you're racing toward. Bootstrapping scales more methodically. You scale only when revenue can support it. Start with a simple website, manual processes, then invest in more sophisticated systems as you grow. This minimizes financial risk. Operational costs don't outpace revenue. It might limit ultimate size or speed to expand, but it creates a resilient model not dependent on the next funding round. It's about a solid, profitable machine that grows sustainably, not a rocket that might explode on the launch pad. To make this real, let's look at two legends who chose opposite paths. First, consider Mailchimp. Ben Chestnut and Dan Curzius. They started a web design agency and built Mailchimp as a side project. They didn't take a single dollar of outside funding. For years, they bootstrapped. They reinvested profits from their agency, and later, from Mailchimp itself, back into the business. They grew slowly, deliberately, with an obsessive focus on customers and on building a product people loved. No pressure to grow at all costs. They could be patient and perfect the platform. The result? A quirky, beloved brand, and a resilient company. In 2021, Intuit acquired Mailchimp for $12 billion. Chestnut and his co-founder owned the entire company. No long list of investors to split the payday. The bootstrapper's dream: patience, grit, profitable on your own terms. Now the other side, Uber. Travis Kalanick and Garrett Camp had a revolutionary idea that needed massive capital. Build a complex app, recruit millions of drivers, recruit millions of riders, navigate legal minefields, launch in cities around the world. This was winner take all. It couldn't be slow. Bootstrapping wasn't an option. Uber relied on VC-fueled blitzscaling. They raised billions from venture capital, to fund aggressive expansion, to subsidize rides, to capture market share. It worked. Uber became a global verb and changed transportation. But the cost was huge. Massive cash burn, sacrificed short-term profitability for scale. Investor pressure fueled an aggressive, controversial culture. At IPO, the founder's ownership was heavily diluted. Uber, the classic VC path. High risk, high burn, high speed for a world-changing outcome. Lead into broader founder scenarios, say biotech hardware. So how do you choose? It's not a coin flip, it's a strategic decision. Here's a simple 3-step framework to guide you. First, get brutally honest about your business goals and the nature of your company. What are you actually trying to build? Niche software tool, profitable with 1,000 paying customers. Deep tech hardware, millions in R&D before a product. If you can get early revenue and avoid massive upfront capital, bootstrapping is powerful. If you're in biotech or creating a new market category, VC might be your only realistic path. Second, understand the demands of your industry and your competitive landscape. Winner-take-all market, first to scale, wins everything. If so, you need the speed and firepower of venture capital. You can't bring a knife to a gunfight. If the market is fragmented or you're building for a specific audience, a slower, bootstrapped approach can build loyalty and brand without getting crushed by big, well-funded competitors. Are your rivals VC-backed behemoths or smaller independent players? Tailor your strategy to the battlefield. Finally, look in the mirror, understand your values and risk tolerance. What kind of life do you want to live? Do you thrive under intense pressure and welcome oversight from experienced partners? Or do you value autonomy and final say, even if growth is slower? Will you risk personal savings for full ownership, or risk other people's money for a smaller piece of a bigger pie? No right or wrong answer. But your funding path must align with your personality, or you'll invite misery and conflict. This framework forces the hard questions. Align your funding with your business model, your market reality, and your personal DNA. Don't chase VC just because it's glamorous. Don't romanticize bootstrapping if you genuinely need capital. Be a shark. Be calculated. Analyze every angle. Be honest about your strengths and your weaknesses. Then make a deliberate, informed decision. Your choice sets the trajectory for your entrepreneurial career. Brief recap and call to action to think through steps. At the end of the day, there is no universal playbook for success. There is no single right answer in the debate between venture capital and bootstrapping. The stories of Mailchimp and Uber prove that legendary companies can be built on both sides of this divide. The only thing that matters is finding the path that aligns with your vision, your business, and your soul. Whether you step onto the rocket ship or start laying the first brick, own your decision. Because the path you choose won't just fund your company, it will define your legend. Now stop reading and start building. There's no one-size-fits-all. Choose the path that fits your vision. Like, subscribe, and comment below. Which path are you taking?